Friends, good day. Today's lesson is lesson number 8 of the Options Are Easy Trading course. Today we're finally moving on to option strategies. In this video we will be looking at vertical spreads. Very interesting strategies. I suggest we start with them. But at the beginning I will remind you what we have already been through in the previous lessons. In the first lesson, we got acquainted with the terminology of options trading. We learned what volatility is. We learned what volatility curves are. I explained how to do options award calculations. A very important topic was what are option Greeks. Remember, delta, gamma, vega, theta. We need to know about the Greeks because we will be using them in the future analysis of option strategies. Lesson number 7 was an important topic, margin requirements. I received a very important question in the comments. Is there portfolio margining on the AE exchange? The answer is, of course there is. Perhaps I did not stop at this point because it is there by default. All risks are summarized when calculating margin requirements. For example, if you bought some additional options, your margin requirements will decrease. Margin requirements are calculated based on open positions. If you have a vertical spread, bought additional options, then the summation will take place, focusing on all your active strategies. The AE exchange risk module also works very well in calculating calendar spreads. Exceptionally fair margin requirements with calendar spreads. There are no additional conditions for portfolio margining, no minimum deposits or anything like that. Now, let's finally get to the topic of the lesson, vertical spreads. What do vertical spreads give us? They allow us to participate in the price movement of a financial asset. But we are working with Bitcoin today. It recently had a good growth, above 30,000. If we expect the Bitcoin price to continue to grow, a good idea is to buy a long position to make a purchase. For example, a vertical call spread. Now I will show you how to do it. Let's first buy 1,000 call options of strike 31,000 and sell, for example, options with strike of 31,500. And we get a strategy like this. Since we already know the terminology, we can speak the same language and navigate here easily. We have a delta positive strategy. We have bought call options of the near strike and sold call options of the far strike. The near strike will have a higher delta. As the price rises, we will make a profit, which is why the strategy is called delta positive. The objective of this vertical spread is to make money on a rising price. What is the main advantage of vertical spreads? We immediately have a certain stop loss and take profit. The take profit is $357 with the award of $143. If the price rises above the strike mark of the call options we sold, we get twice as much profit. The main advantage of vertical spreads is that we have a stop loss and take profit. Vertical spreads are better used in the out-of-the-money zone. Now I will demonstrate it with another variant. 1,000 contracts. Why 1,000? Because 1,000 is exactly 1 Bitcoin. It's easier to navigate. I buy call options 32. I sell call options 33. So here's the strategy. The maximum profit in the vertical spread is equal to the sum of the sold option minus the sum of the bought options. We sold call 33, bought call 32. The profit is 1,000 if the strategy works. Accordingly, 1,000 is the maximum profit possible in this spread. From the maximum profit, we deduct the same amount we paid for it. And we paid $76. We get $924 of potential profit, taking into account the commission, of course. The profit is about 10 times more here. Bitcoin price continues to grow, although the expiration is very soon. If the price does not lose momentum and rises above the price of the sold strike, 33, we will get a profit of $924. And the maximum risk of this spread is $76. That's why I like these spreads. It was strategy based on price growth. But it could happen that the SEC says something weird about cryptocurrency again and people start dumping crypto. Then the price of Bitcoin could drop significantly. Then we can buy a vertical spread on put options. For example, we buy 29,500 and we sell 29,000. Sell 1,000 contracts. We get a vertical spread with a very small award. We spent $39 to buy. The maximum profit will be $500. It's the difference between the strikes. It's clear. So $461 is the potential profit. If such a movement happens before expiration, the price falls below 29,500. We will get such profit. I think that vertical spreads are a great tool to catch the price movement. We have talked about buying vertical spreads. Now let's talk about selling spreads. If we expect the price to fall, we can do the following. If we make the assumption that the price will not fall below 30K, then we can try to make money on it. It turns out that we are betting that a certain event will not happen. That is, the price will not move. This is done by selling vertical spread. We sell the near strike, 30,000, and buy the far strike, 29,500. In this case, we expect the price to not fall below 30,000 anytime soon, and then we will get the award, which is $85. If the bought vertical spread has margin requirements equal to the award, the sold one has the calculations done in this line here. See? With both futures and delta hedging, all calculations can be done in this line. In this case, our margin requirements are $395. It turns out that our profit will be about 20% of the involved funds. Let's look at the other vertical spreads as an example. Call options have a different strike. If we do not expect the price to rise above 31,500, we sell call options at strike 31,500 and buy call options at strike 32,000. The margin requirements of such a spread will be $400 and the profits will be $91. This is, of course, provided that the price does not rise above 31,500 before the expiration date. It is not the best strategy, I show it just as an example for training. So, what conclusions can be drawn? These are absolutely great strategies for catching market movements. If you want to catch a price rise or fall, together with automatic stop loss and take profit, you can eliminate the human factor and make money with a vertical spread. If you want to sell vertical spreads, betting that no price movement will happen, you can make money on that too. Linear instruments, such as futures for example, do not allow to make money on the bet that an event will not happen. We allow a small increase, but not above a certain price. This is the advantage of options. Before opening a position, be sure to do some preliminary calculations, modeling, pay attention to margin requirements, change the volatility, the price of the basic asset, see what it affects. Let me remind you, a sold call spread has a negative delta, negative gamma, positive theta, negative vega. I also want to talk about synthetic futures and the call and put parity rules, but more on that in the next lesson. That's all I wanted to tell you about investment strategies and vertical spreads for now. Feel free to ask questions in the comments. Put likes if you liked this lesson. Use vertical spreads in trading. Make money. Subscribe to the channel with interesting information about investment strategies. I wish you all the best.